The government's decision to recapitalize Indian public sector banks has led to an active debate on what this means for the economy and the direction of interest rates. In a note on Wednesday, Goldman Sachs said that every incremental 10,000 crore rupees of bank capital infusion can lead to an increase in credit growth by 1 percentage point and an increase in GDP growth by 0.5 percentage point. Goldman goes on to add in that report that as growth picks up, this will be bullish for equities, it will be bullish for the Indian rupee, but it will be bearish for rates as the RBI may hike rates faster than anticipated. In that report, they say that they expect the RBI to hike rates by 3 times, not by 3 times, hike rates 3 times by the end of 2018.
That's a view from Goldman, but here's a counter view. Bank recap plan may actually fizzle out if this is not accompanied by cutting interest rates, says Abhishek Gupta from Bloomberg Intelligence. He's here with us to defend his position. You're taking on Goldman right now. Tell us why you think the bank recap plan may fizzle out if this is not a dovetail with cutting interest rates.
So essentially what I do is I look at 2 interesting questions in this report. Number one is the question about are the banks currently the low credit growth in the economy? Is that because the banks are capital constrained, or is there a weak demand situation in the economy? The analysis suggests that overall the entire banking system has enough capital currently to grow at about 10%. Credit growth is currently at 7.5%. So essentially it boils down to the issue that demand is really weak right now. Real interest rates are too high in the economy. But at the same time, individual public sector banks are capital constrained. If we look at the 20 public sector banks, I think around 10 of them are capital constrained, which need to sort of shrink by 10% their book. The capital adequate banks can actually grow up to like 20%. So essentially it's an interplay of both supply and demand issues, but at present it's more of a demand issue.
Just hold the thought, Abhishek. Let's just bring that chart on the screen once again, talking about how credit growth has played out over the last several years. And if you just see the right-hand side corner of the screen, a marginal uptick, a marginal uptick in credit offtake. And many people would argue, Abhishek, that this has been because, and this is just a counter view, that this has been because of unwillingness of bankers to lend as compared to deficiency in demand.
Yeah, so elaborating on the earlier point, the second question is the government's decision to recapitalize banks by up to 2.1 trillion rupees. Will that be sufficient to provide the regulatory capital requirements of the banks? And in addition to that, leave also sufficient growth capital with the banks? So over here, the analysis suggests that RBI rate cuts will help not only on the supply side, also on the demand side. So demand side is well known. I mean, rate cuts help in propelling growth and creating demand for the economy. On the supply side, rate cuts can help in sort of the kickstarting in growth. That can help in reducing the loan loss provisions. And that can essentially leave the banks with higher capital to fund new loan growth.
Sorry, Abhishek, I have 2 problems with what you're saying. One, on the second point in your report, you talk about the fact that lower interest rates will allow this bad loan problem to get resolved a little bit faster because interest rates for corporates will come down, etc. But that's exactly what you don't want to do. And the RBI Deputy Governor Viral Acharya has said in the minutes that you cannot have rates which are so low that the hurdle rate for evergreening is low for these companies. You cannot allow that. And on the second side, I mean, this is now a flexible inflation targeting central bank. How can they say that, we want to revive animal spirits? They have to look at inflation pure and simple. And if the output gap is negative and widening on the negative side, sure, there is an argument to be made for cutting interest rates. But these arguments seem a little bit outside the realm of central banking.
So let me just first sort of address each of these issues one by one. Number one, Viral Acharya's whole analysis is that bank recapitalization, or interest rate cuts need to be preceded by bank recapitalization so that there is no evergreening. So if you cut interest rates, what happens is public sector banks sitting on excess SLR are going to get windfall gains on their asset book. And the RBI does not want those gains to go into the existing bad loans. That is why they are proposing bank.
I don't think that's their problem. I think their problem is that you lower interest rates too much. You allow these guys to refinance a little bit too easily.
Essentially.
And risk pricing is not appropriate. If the market is flooded with liquidity, you misprice risk. I think that is the problem.
No, I think essentially in that case, there is there isn't any demand. I mean, as we can see in the chart earlier, the credit growth is too low. So coming back to the earlier point, the issue over here is if banks are well recapitalized, then they will not be scared of giving out loans to fresh demand in the market. The other 2 points which you mentioned, Ira, on inflation and output gap, over here my view is slightly different. Like my inflation projections show that inflation is nowhere close to coming up to 4% mark.
Sure.
In fact, inflation should head at around 3% by end of March 2018.
No, and if you're right on that, then sure, the RBI should.
So inflation is already undershooting. Like the last inflation print was 3.2%, whereas market was expecting to be 3.6%. October again looks like around 3.3 or so, which is an undershooting of 90 basis points given RBI's own projection of 4.2% in October. So that's a big undershoot. Given these things and the fact that you want this recapitalization program to be a success, interest rates can only help and support this recapitalization program by ensuring there is sufficient capital for banks to not only meet the regulatory requirements, but also they have enough growth capital.
Abhishek, thanks so much for that view. Like we said, a healthy debate going on which way this is going to play out for the broader economy and for interest rates.